Hi everyone, I'm Rob Schmidt with another edition of Financial Planning 101, where I show you how to make money and save money by explaining some financial matters in a way anyone can understand. In this video, I have the great privilege of honoring a request from Chris Russ. Chris wants more information about various retirement accounts, and we're going to start out with I.R.A.s, individual retirement accounts, which can only be owned by the individual who has earned income they want to invest in their retirement. Your spouse cannot share in the ownership, and while it's true that other people, maybe a parent or grandparent, can invest money on your behalf, their name will never go on the ownership of your individual retirement account. Just the way it is. There are two types of I.R.A.s. Qualified plan, and in order to be qualified, it must be offered to all of the employees of the company, regardless if you want to or not. It also must meet the guidelines of I.R.A.s. I.R.A.s stands for the Employee Retirement Income Securities Act. So in order to be qualified, it must meet those guidelines. Non-qualified plans are not subjected to those guidelines and are usually offered to executives. Now, there are two ways that you can contribute, that you can invest in your I.R.A. Number one is the traditional method, which uses pre-tax revenue. So if you start out with a tax basis of $50,000 and you invest $5,000, your tax basis is lowered to $45,000. Roth plans, on the other hand, they use after-tax contributions. So you pay your taxes first, then you invest the money. That's how it works. I also need to emphasize that in order to avoid a nasty 10% early withdrawal penalty, you have to wait until you're at least 59.5 years old. That's the law. And to add insult to injury, you have to take it all out by the time you're 70.5 to avoid a 50% distribution penalty. That's just the way the law is, ladies and gentlemen. Now, you're still going to pay taxes on it, but there are certain ways to avoid the 10% penalty. Number one, certain disabilities qualify. Number two, death. Unlike Social Security, your I.R.A. can go to anyone you will it to once you're dead. It's not Social Security. Three, certain first-time residential expenses, usually up to about $10,000, qualify for the 10% income. Check with your CPA. Also, certain medical and educational expenses also qualify. And this is very important, if you make a series of substantial payments known as 72T payments, you can avoid the 10% penalty. You're still going to have to pay taxes, but usually when you liquidate it, you're paying at a lower marginal tax rate, which is one of the main attractions of I.R.A.s. And on a final note, and I've done this before so I know, you can borrow money from your I.R.A. up to 60 days. You have to pay it all back though. If you don't pay it all back, you're going to get hit with a penalty and you're going to have to pay taxes. If you pay it all back within 60 days, no prepayment penalty, no 10% penalty. You might even be able to avoid taxes if it's paid back in full, but I would strongly encourage you to discuss that with your tax professional. Hopefully you have a CPA that you trust. That's a pretty good overall description of I.R.A.s. If anybody out there has any further questions with regard to this, by all means, share your thoughts with me in the YouTube Message Center. And in the meantime, may God be with you all.